Good afternoon, everyone, and welcome to Under the Rug. It's a channel where I try to lift the lid on the deception in financial markets, media, and politics. My name is Michael Smugin. I'm an advisor, and it's the 5th of January 2024. And today I'm going to be talking about why I think 2024 is going to be a year of significant turmoil in the global economy and financial markets. So where I thought we'd start today is in the area of interest rates. Interest rates are obviously very key in people's decision making, not only people's, but corporations and governments when making financial decisions. So the outlook for interest rates is very important as far as considering where other asset classes will go this year. Now, one thing to note about interest rates is we've had a lot of manipulation in this area, particularly since the global financial crisis. Looking at the United States, which is still the largest economy and the most influential financial markets in the world, if we have a look at the interest rate policy settings as set by the Federal Reserve, the central bank over there, what we can see is for the last 13 years, since the global financial crisis, interest rates have been held at the lowest levels in all of history, all of recorded history, virtually 0% for much of the last 13 years. Now, the reason why this is notable is that with interest rates being at virtually 0%, essentially the central planners have encouraged some of the biggest asset bubbles we've ever seen in recorded history. When you put interest rates at 0%, you're essentially encouraging individuals, corporations, and governments to borrow at historically low levels and speculate into areas of the market which they may not necessarily have done if interest rates were set by the free market. And we can see the effect of these interest rates being at virtually zero for the last 13 years when we're talking about asset bubbles. One example here is what you can see on the S&P 500 over a longer time frame. S&P 500 being the index for the 500 biggest companies by market weight in the United States. We can see the last two major downturns, or crashes if you want to call them, in the stock market occurred in the early 2000s with the onset of the tech bubble, where the Nasdaq got really expensive. And then you had the global financial crisis in 2007, 2008, which was largely kicked off by the real estate crisis in the United States. So we had a significant drop, 50% odd drop in the stock market between 2007, 2008, and we had a bottom in 2009. Now, since 2009, what we can see is the stock market has gone up on a tear. It's gone, almost vertical to the moon. And again, this has all been encouraged by interest rates being suppressed artificially at historically low levels. One of the questions to ask is, would the stock market have gone up the way it did in light of interest rates being held where they were? Most likely not. So going into 2024, one of the questions to ask is, can these asset bubbles be maintained? On pretty much any valuation metric at the moment, if you look, for example, at the stock market, the share market is at overvalued levels. Whether you're looking at price to earnings multiples, whether you're looking at the Warren Buffett indicator, price to book, all of these things indicate that the stock market is overvalued, but it can remain overvalued so long as interest rates are virtually 0%. But what we've seen just in the last 18 months, we've seen some of the most rapid increases in interest rates as set by most central banks around the world. So why have interest rates gone up so quickly? Well, it's on the back of inflation rates being at some of the highest levels in 40 to 50 years. If we have a look at, for example, at the Consumer Price Index in the United States, this is the official measure of inflation. We can see that inflation ran from 2020 all the way up to close to 10%, which was the highest level of inflation since the early 1980s. Similar story in the Eurozone and in Australia. We had inflation run from virtually zero up to 7%, which is the highest level since the early 1990s. One thing to note with this data, this CPI, which is put out by the US Bureau of Labor Statistics, the government over in the United States, is that it is very heavily manipulated data. They use all sorts of tricks and hedonics, but there is a gentleman by the name of John Williams from Shadow Stats, and he gives a more fair or a truer reflection of what inflation really is. If it was measured the way it was in the 80s and 90s, he's saying that inflation will be somewhere closer to around 12 to 13% in the United States. And that's the truer number. If you have a look at the cost of groceries, you look at fuel, you look at your electricity bill in Australia here, I mean, there's no way that inflation's sitting at around 5%. It's probably closer to somewhere double that over the last sort of 12 months. Now, if we have a look at inflation and what's been driving this massive increase, it is a global phenomenon. There is a direct correlation to money supply. So going into early 2020, when COVID broke out and we had lockdowns around the world, what we saw in response to that was central banks increasing the money supply, or money printing, at a rate that we've never seen before in recorded history, in modern history anyway. So for example, in the United States, somewhere in the order of 7.5 to 8 trillion US dollars was created out of thin air to fund all of the bailout checks and the stimulus checks for those individuals and businesses that were laid off their staff for a virus that had very minimal harm to the overall population. And what you can see here was inflation as measured by the Austrian School of Economics, which is as defined by an increase in the money supply. That 7.5 trillion US dollars, it represented somewhere close to 40% of all the US dollars ever created, being created in a space of around 18 months. And that coincides directly with the timing of the CPI, the inflation numbers, running up from 2020 up to 2022. And you can also see that inflation has come off in recent times. And again, why is that? It's because we've had a significant deceleration now in the amount or the increase in the money supply. So for all the stories that we're told that, that inflation is caused by greedy businesses and supply chain disruptions, look, that's definitely added to some of the cost increase pressures. Most of the cost of living pressure that we see today is a direct consequence of the actions that governments and central banks took during those COVID years. And the ironic thing now is that the central planners or the central banks who are tasked with getting these prices under control are the same ones who created the problem in the first place. And there's, look, real world problems now. We can see it in the Australian property market. We've got families who are struggling now especially the ones who took on a lot of debt here and were encouraged to do so at these historically low interest rates. You could pick up mortgages under 2% back in 2020, 21. They're now struggling to meet their minimum mortgage repayments, and anecdotal evidence is showing that a lot of people are at risk of losing their homes over the course of the next 2024 and 25. So as far as the outlook for interest rates, we do need to also consider what's the outlook for inflation. Now, what we do know is, as far as inflation goes, a lot of it's going to depend on what happens in geopolitics. So if we have a look at particularly what's happening at the moment in the Middle East, we have a situation with the Israeli-Gaza conflict, and that's now spilling over into the Red Sea, where you've got Houthi rebels, which are Iranian-backed, attacking commercial shipping vessels in the Red Sea, and that's resulting in a lot of these shipping vessels having to go down below the Cape of Good Hope at the southernmost point of Africa, rather than going directly through the middle of the Red Sea, which is delaying shipping time, it's increasing fuel costs. And a lot of that is potentially going to translate into higher consumer prices as these prices are passed on to the end user. But more concerningly also is the potential for a higher oil price. So if we do see a situation where this conflict escalates, where other countries start to get involved, such as Lebanon, Syria, Egypt, then there is a real potential for the oil price to start to really take off. And there is some precedent for that in the 1970s. We saw that with the oil embargoes during the Yom Kippur War. And oil is the lifeblood of the economy. It's used in so many different consumer products. So that's one key area to watch going forward, is what's going to happen in the Middle East. And even though the Russia-Ukraine geopolitical conflict has been dying down in the media, and the media has not been wanting to admit that, the Ukraine really has been decimated, there is a lot of analysts out there who are talking about a potential for some kind of event to happen, whether it's a false flag, something along those lines, to try to reignite interest in that area. So these are all potential areas in 2024 to watch for an increase in inflation. And another area to consider also is what's actually happening with the state of US government finances at the moment. So if we have a look at the US government and the deficits they're running at the moment, I have a chart here. So the US Treasury at the moment, they're running a $2 trillion annual deficit. Essentially what that means is they are spending $2 trillion more every year than what they are bringing in tax revenue. And that's all being funded through essentially expanding the balance sheet or printing currency, which is increasing the debt for the government. So what you can see here is that as the deficit increases and as potentially revenue falls, particularly if the US economy goes into recession officially this year, then that deficit will continue to increase. And not only will the deficit increase, but the amount of debt will increase, which is now just ticked over $34 trillion in 2024. So the conundrum for the government over in the United States is this is debt that will never be able to be paid off. They can only continue to finance the deficit through printing currency, which is, as I showed you before, significantly inflationary. And going forward, what we're seeing is that the situation for the government finances is becoming quite dire, because if you have a look at the interest on that $34 trillion, it's now at $1 trillion per year, and it's projected to increase at a significantly increasing rate going forward. Now, one of the concerns for inflation is it's not only with what's happening with geopolitical conflicts, it's what's going to be happening in the US Treasury market going forward. So if we have a look at government bonds and the 10-year bond yield, this is the key benchmark interest rate pretty much for all interest rates around the world. So what happens on the 10-year bond yield will dictate where interest rates on mortgages, on credit cards, on personal loans across the globe will go. But what we can see is that for the last 40 years, we've had declining interest rates. So since the peak of 1980, where the 10-year bond yield got close to 16%, we've had a 40-year downtrend in that 10-year bond yield, which means that interest rates around the world have also, on pretty much every asset class, have trended lower for the last 40 years. And that's why it's been quite easy for asset prices to go higher, because in a declining interest rate environment, you have what's called the positive wealth effect. So as interest rates go down, people feel wealthier, they're more inclined to spend in the real economy. And the other factor is that as interest rates go down, you generally qualify for more debt. And as I mentioned, what we've seen since the lows of 2020, where interest rates got down to the ridiculous level of about 0.4 or 5% on this 10-year bond yield, we've had the most rapid increase in interest rates. So we are nowhere near the highest interest rates in history. but the percentage increase has been quite extraordinary, from basically under 0.5% to around 5% as little as a few months ago. And that's translated to some of the quickest increase in mortgage rates as well. For example, in the United States, we had mortgage rates going from around 2% up to 8%. And in Australia, we've also had mortgage rates go up to around 7% as well. So with respect to bond markets going forward, so what's driving this increase in yields? So we've already talked about the expectation for higher inflation. So that's obviously been a reflection of higher inflation going forward. But a lot of this increase in the yields is also a factor or a result of governments increasingly diversifying outside of or away from the US dollar. So we have this what's called de-dollarization trend that's happening at the moment. And why is that happening? Well, one of the reasons is, as I just mentioned, it's the way the US government is managing its finances at the moment. With that $2 trillion annual deficit, with interest costs now at $1 trillion per year and projected to increase significantly, with the national debt being $34 trillion, and the next $1 trillion of debt expected to increase in the next 6 months. That's making a lot of countries nervous about holding US government bonds. So if we do have a situation where Japan and China, for example, I believe they're the biggest holders of US government debt, if they increasingly reduce their exposure to US government bonds, that's going to put upward pressure on yields. So irrespective of what happens with the official interest rates as set by the central banks of the world, including the US Federal Reserve, the biggest and most powerful organization in the world, interest rates can continue to go up outside of those policy settings by the central banks. And one of the key concerns that we see as far as this de-dollarization trend is what's happening in the BRICS movement. So that represents Brazil, Russia, India, China, and South Africa. And we've just had a number of countries which have joined that BRICS coalition. And those countries include Saudi Arabia, Egypt, Ethiopia, Iran, and the United Arab Emirates. They've all joined the BRICS officially in 2024. Now, Saudi Arabia in particular it has played a massive part in terms of sustaining the US dollar's world reserve currency status. And they call it the petrodollar status. So in 1974, there was a deal that was struck between the United States, which was, I believe, was brokered through Henry Kissinger, and the Saudi Kingdom. And the deal was that the Saudi Kingdom would only sell their oil in US dollars, and in return, the Saudi Kingdom would receive the protection of the US military. And as a result of that deal, what it's meant for the last 50 years is that all nations that traded with the major oil exporting countries like Saudi Arabia, they had to purchase US dollars first before they bought that commodity, that oil. So that's resulted in an artificial demand for US dollars for the best part of the last 50 years. And what we are seeing now is, for the first time since 1974, we are seeing a breaking away from this petrodollar system, where now the Saudi Arabia is selling its oil in other currencies other than US dollars, in yuan with China, in rubles with Russia. So this is a massive sea change in some of these developments, these macroeconomic developments. And one thing that we can see with this 10-year bond yield is this 40-year downtrend has clearly been broken. And if you take an interest rate chart, go back over 200 odd years, what you can see is that there is a cycle, and that cycle can last 30 to 40 years. And we can see that, for example, since World War II, for example, interest rates went up from around 1944, 45 and peaked in 1980. So we had a big stagflationary period through the 1970s. So we had that interest rate cycle going up for close to 30 to 40 years, and now we've had a down cycle for 40 years that's ended. And going forward, it's going to be much harder for interest rates to get anywhere near where they were back in 2020 or even for the last sort of 13 years, because all of that is very inflationary for the US economy. But this coalition of the BRICS is very big news, and it has the potential to be very disruptive in 2024. And it doesn't look like there's going to be peace anytime soon. If anything, these geopolitical conflicts, unfortunately, are ramping up, and the move away from the US dollar will continue. So the key thing to understand with the US dollar, and this is why I'm mentioning it, is the correlation between the US dollar and commodity prices is very strong. So because most commodities are priced in US dollars, you do have an inverse correlation between US dollars and commodity prices. So if we have a look at, if I have it here, a chart of the US dollar, one of the key levels to watch, so this is a chart of the DXY or the DXY, the dollar index, which is a basket of it's the US dollar relative to about, I think, 12 or 13 different currencies. So it's measuring the strength of the US dollar against a basket of different currencies. And what we can see here is that from around October of 2022, the US dollar has been trending downward quite notably. And the reason why it has been trending lower is because there's a sense that inflation now is under control, that interest rates can now start to be cut. And that's what the US Fed Reserve has been talking about. It's been talking about a more dovish tone in 2024. And there's an expectation that we're going to potentially see the first interest rate cuts around April, possibly May. Now, the key level to watch on this US dollar index is around that 100 level. So from a technical analysis standpoint, you can see that that 100 to 101 level is a key level of support for the US dollar. Now, if it does break down through that, what it would signify potentially now is you're going to see an acceleration in the downtrend for the US dollar relative to its rival currencies. And the reason why that's important to note is if we do see this event play out, then you're going to see a basket of commodities start to increase in value as the dollar goes down because of that inverse correlation. And all the trends at the moment with this de-dollarization movement that we're seeing are pointing to a lower US dollar. So as more countries move away from holding US dollar reserves and moving to alternative currencies, obviously the demand for US dollars is going to continue to go down. Now, one of the key things that we're also seeing is, and this is what I think set off, particularly back in 2022, if you think about the onset of the Russia-Ukraine crisis, there was a freezing of Russia's US dollar reserve assets. And that set a precedent for a lot of other countries to consider retaining US dollar reserves. Because if the US government can freeze Russia's US dollar holdings, and it was to the value of about $200 billion, other countries now are starting to question whether the same thing will happen to them if the United States does not like their politics. And in more recent weeks, we've been also hearing that because there's been a lack of appetite for the Ukraine war to continue in the US Congress, the government there is also considering using those frozen $200 billion worth of Russia's assets, 200 billion US dollars, to continue to fund that war. So that's only accelerating the move away from US dollars by other countries. And the BRICS movement, it is significant. If you look at these 5 countries that have joined, we're now talking about somewhere close to 40 to 50% of the world's population. Not sure what the exact percentage is, but a significant amount of GDP for the global economy and a significant amount of the world's population as well. So again, the key thing for the US dollar is if the outlook is for lower inflation, then that would be very bearish for the US dollar. But it's that movement away from the US dollar by the BRICS economies, which has the potential to really start to decelerate. And also the move away from the petrodollar system that has the potential to really decelerate the US dollar price, which is going to put upward pressure on commodity prices and send those consumer price index levels back up. So one of the last things I wanted to talk about for this particular session is what's happening with the US banks. So one thing we want to have a look at is in 2023, there were, in March, around that time, March, April, we had a number of significant banking failures in the United States. We had Silicon Valley Bank, First Republic, I think Silvergate, a number of significant banks failed last year. And the reason why they failed, it has a lot to do with a lot of this money that was created, these US dollars that were created back in 2020 and 21. So with these trillions of dollars that were printed out of thin air, we know that a lot of this money was used to fund the stimulus checks during COVID. We also know that the US Fed Reserve, the central bank, funneled a lot of this money into the US banking system with the view of the banks lending this money out to try to stimulate economic activity. Now, because we've just had the biggest crash in government bonds and the sharpest increase in interest rates in percentage terms in modern history, so the banks that were, what they did, that these banks that received this money from the Fed Reserve, they bought government treasuries or US government bonds in the hundreds of billions of dollars. And because of the biggest crash in government bonds that we've seen in the last couple of years, and just remember, this is a safe haven asset. You know, if you have a look in mainstream financial advice, the government bond sector is considered a safe place to have your money. So the result of this crash in government bonds is that we've seen a number of bank failures, but we've also seen now, as far as the unrealized losses on the banks that bought these treasuries back in 2020 and 21, it's around 650 billion US dollars. So one of the concerns is if we do see an uptick in inflation and interest rates, what it means is that the losses on those government bonds will continue to increase. And if there is nervousness in the banking system, because of the fact that we have this fractional reserve banking system where the banks only need to hold a small percentage of deposits and they can lend the majority out 10 times over, if you do have what's called a bank run where you do get some nervousness around financial institutions, then there is the potential for more banks to fail, because that's essentially what happened last year, was that these banks had to sell these US treasuries at significant losses to fund customer deposits, which rendered them insolvent. So we've got institutions like JP Morgan, Bank of America, and they've reported 40 billion and over 150 billion, I believe, in unrealized losses in the last reporting period. This is something that, you know, has the potential to really scale up in 2024. So definitely something to be aware of. But if we do have another banking crisis, obviously that will also place a lot of upward pressure on these bond yields, because again, it's another excuse for international investors to dump their bonds. You know, it's not a good look for a country to have its banks start to fail, to have this de-dollarization process. Essentially, the US government is bankrupt. Why would these countries want to hold US treasuries? So with the breaking of this 40-year downtrend, I believe we are in a new bear market in government bonds, or a new upcycle in interest rates, which has the potential for further bank failures in 2024. So, and what it means is for the US dollar, just the last point is, and we've been talking a lot about the US economy and the implications for the United States. It is a global thing, obviously, but the privilege that the United States economy is enjoyed by having that US dollar reserve status, I believe the United States economy will be hit harder than others in terms of the inflation impact, because the privilege that the United States has been able to enjoy is that they've been able to print currency out of thin air and exchange that paper for real commodities. And if this de-dollarization process continues, that privilege is going to continue to be whittled away. And unfortunately for a lot of consumers over there, that means significant cost of living pressure. But again, it is a global thing. If these interest rates do continue to go higher, obviously it means that mortgage rates will continue to go higher as well. And that's the reverse of that positive wealth effect that I mentioned before. If interest rates are going higher, It means that people feel less wealthy because there's less disposable income to spend. It means less people are going to be eligible to borrow as much money for the same valued property over the last couple of years. So all of a sudden you start to reduce the pool of buyers that are available to purchase the properties that are on the market. And that's why the government has opened the doors to this record immigration over the last sort of 12 months to try to soak up that supply. So it's going to be an interesting 2024, whatever happens. I believe we're seeing some historical trends taking place. And just want to thank you for taking the time to listen to me over the last half an hour or so. And what I'd like, please like and subscribe the video if you're interested in more content. And I look forward to speaking with you all soon. Thank you. Bye.